Today, very interesting. On GST, I am going to discuss the brief working of input tax credit, because we come across this word input tax credit, ITC, ITC, ITC. See, for the commerce literates, yes, they know what is ITC, what is input tax credit, particularly students. Students of commerce, students of taxation, they understand this. But from the layman's point of view, what is ITC? What is input tax credit? So, in this video lecture, I would like to explain briefly what is input tax credit. You see here, GST, under GST, what is input tax credit? Why input tax credit is there or is necessary or is useful? How it works, what it is, why it is, and how it is, what is. So, everything is, all discussion will be around ITC only, input tax credit only. So, for that what I do is, I start with an example, very simple practical example. See what categories of suppliers are there under GST, because you know GST covers sales tax area, manufacturing area, and also service area. Mainly these three areas put together are called supply under GST. So, supply of goods or services or both, combination of goods and services, right? This much everybody knows. So, what I do here is how the mechanism, working mechanism, what is the working mechanism of ITC, that is input tax credit, what it is, I would like to highlight through examples. So, first example what I do is, say let us say a trader, I take the example of a trader, traders are everywhere. So, this is example number 1. What it is to a trader? So, a trader basically is a person who is buying and selling commodities, activities of buying and selling. He buys goods and he sells goods. Okay. So, how it works? Let me take an example. Here he is purchasing some commodities, that is called input purchase. I call it input. Let us say on his inputs, say 10,000 rupees is the purchase cost, and he is paying say 10% tax, that is GST. So, he is paying GST on his purchases because he has purchased goods, that is called inward supply. Purchase of goods is an inward supply. So, let us say 10%. Actually, GST rate is not 10%, but I am taking 10% for simplification purpose here. So, 1000 rupees is the GST, that is tax he is paying. And again, he is having some furniture, showcase, etc., etc. He got some capital goods. So, what is capital goods? Very simple. Whatever you capitalize in your books of accounts and which you use them in the course of or in furtherance of your business. If you look at GST. So, trader normally has some setup, capital goods are there, some equipment are there, maybe sometimes air conditioning is there. These are all of the nature of capital goods, furniture, showcase, etc. So, he has some capital goods on which, say, straight away I take, he paid a GST, he bought them, he brought them, he paid a GST of say 500 rupees. It is tax. I am not taking value, I am straight away taking the tax. So, on capital goods that he is using in the business, he paid 500 rupees as GST. And services. So, he is also taking services because nowadays without services there is nothing. You know that. So obviously, all types of services, maybe he is taking the services of an auditor, chartered accountant services, where he has to pay tax, or accountant services, whatever be the services, courier services, transportation services, and so on and so forth. You name it and you have it, because everything is taxable today. So he is also taking services in furtherance of his business. So he is paying service tax. Let us say he is paying 300 rupees as GST for the services he is receiving. 300 rupees. So this you can also call it as input service. Input service and capital goods. Because it is an input for the output. This it is his output. For that he is taking something that is called input. So input services and capital goods, these three things he is using. So what for he is using all these three? For the purpose of output supply. He is selling actually. It is a sale, but technically we call it output supply or outward supply. So for his outward supply or output supply, he is getting, say, let us say he is selling the goods for 25,000 rupees. It is the price before tax, and he is paying GST. Let us say GST of 10%. Let us say 2,500. He is paying a GST because on his outward supply he has to pay tax, that is GST. GST is payable, and I have calculated 10%, it is the price, and 10%, 2,500 is the tax. So this is the tax on the whole amount, whole of the sales value, that is gross value of sales. But because GST is a value added tax, so in value added tax, tax is paid on value addition only, not on the entire gross value. So when you are paying tax on value addition only, you are removing cascading effect here. Tax on tax, there is no question. So how it does? To effect that, the taxes paid on input services and capital goods are available as set off here. So I'll write here, that is available as set off. These taxes are available as set off. Okay. So this 1,000 rupees because you know input services and capital goods, all the three have been used for his business, in his business. So 2,500 is set off by, say, 1,000 input tax on input, that is GST on input, and 300 services and 500 on capital goods. Put together 1,800 is the input tax credit. So taxes paid on input capital goods and input services is called input tax credit, and this 18 of 7 net. This is the value. This is the tax on value addition. So 700 is the tax on value addition, and 1,800 is the tax on input. Tax on input plus the tax on value addition is equal to total output tax. You understand? Total output tax is equal to input taxes are at input level. Input level means all the three plus value addition. Put together is 18 plus 7 is equal to 2,500. So I don't think is there any complication. Any complication you feel, you should not feel. So here, this is a case of a trader because he is selling. What happens if a manufacturer is manufacturing goods and selling? So quickly let us look into that also. So I write here 1800 input tax ITC, value addition 700, it is 2500 total. Case number 1. Suppose manufacturer, let me not change, why should I change? Let us say manufacturer also has the same phenomena. I simply change this here. Manufacturer who is manufacturing goods. To make it simple, I will keep all these figures as they are. So he is purchasing inputs, raw material, he is processing, and some processing charges are there, and he is also using capital goods, paid tax, he is also using services. Normally for a manufacturer these expenses will be more, but I am for simplification purpose I am taking them as they are same. So this outward supply for a manufacturer is maybe sale or simply supply, whatever it is. Ultimately he also sells. So for a manufacturer also it works in the same way. So 1800 is the tax at input level and 700 is the value tax payable on value addition. That is how it works for a manufacturer under GST. Okay. So what about service provider? Let us say service provider. It makes no difference. It should make no difference. See, supplier of services. Service supplier. Who is supplying services? Supplier of services also, he is using, let us say, capital goods, he is using some input material, not necessary for some services, but let us assume that he is also using some input material and also using services, paying taxes, and on outward supply of service, output supply is service. On his services supplied by him, this is the tax payable, this is the charge, this is the amount of service charge, and this is the tax payable. Let us assume 10% only. This is the tax payable 10%, and these are the taxes available, and this is the tax net payable 700. So whether it is trader or manufacturer or service provider, process is same. There is something called input level tax, there is something called output level tax, and this input level tax is available as set off against the tax payable at the output level. Is there anything special? Is there anything complex or complicated? No, it cannot be. But in practice, this is not as simple as I explained, because in GST, under the present GST introduced by government, there are 4 varieties of GST: state GST, central GST, integrated GST, and union territory GST. And matching which GST can be set off against which GST. That's an issue. That's not a big issue, but I did not go into the technicalities. Simply, I have taken these as eligible against the output tax payable. Eligible input level taxes payable or set off against the output level taxes. That is, with that assumption, I have used this simple example. So, from this, let us draw certain things. So, first point is, what is GST? What is ITC? What is input tax credit? It is taxes paid. Taxes here means GST. GST paid on number 1 input, number 2 input services and capital goods, right? Taxes paid on input purchases, inward supplies, and input services received, and capital goods used in furtherance of business or for the purpose of business. Done? So this input tax credit. It is called credit. Why it is called credit? Because whatever you deposit, whatever you pay at input level for your capital goods, inputs or input services that you receive inward, you are paying some amount that you can treat it as, you can take it as, assume it as deposit with the government. It is your money just like your deposit with a banker and you withdraw. You can withdraw now. So you have deposited with the banker. Similarly, this amount you have deposited with the government. So that is your credit, just like your credit balance in the bank. So when you do some activity at the output level, output supply, and you are incurring some tax liability, you are liable to pay some tax, that is tax at the output level. So while paying the tax at the output level, you can draw that deposit amount. This is a deposit. And draw that, use it and pay the balance only. So it's like a deposit, you are withdrawing and using. So in this simple example, there is no opening stock, there is no closing stock, everything is exhausted here. That is the example, that is the assumption we have taken. So input tax credit is taxes paid at the input level, is input, input service and capital goods. So what it is done and why it is, why input tax credit, why the phenomena or concept of input tax credit. See, after Second World War, countries, in particular Europe, because Europe was damaged to a maximum extent. Of course, every country was damaged. So the focus was more on business and making money or increasing economic activity, not wars. Through war, there is a lot of collateral damage. All the countries have realized. So there is a lot of public suffering, hardships. So there is a paradigm shift in the thought process, even in the minds of the rulers. So after the Second World War, the rationalization process started and they invented something called a value added taxation system. Earlier, the tax was being collected on goods. Of course, services were hardly there. On goods, the tax was being collected on gross value, total value. So when the tax is collected on gross value, there is an effect of cascading effect. Suppose in this particular case, if the gross value system is followed, even in India we were following. If the gross value system is followed, what happens? Whatever taxes you paid here, you forget. That's gone. That they are not coming with you. And fresh you are paying tax 2500. This is also there. Earlier taxes were also there to the extent of 1800. Now you are also paying 2500. 2500 plus 1800 is equal to 4300. If the gross value system of taxation is followed, 4300 is paid. There is a lot of burden on the consumer. So that was recognized and realized by the people, specialists, and they found, see, already there is some tax and again there should not be there repeatedly here. So to remove the cascading effect, value added taxation system has been introduced. So in the value added taxation system, input level taxes are allowed as set off against the output level taxes. Thereby, only on value addition you are paying tax. Okay? So only on value addition you are paying tax. The best method of value addition method is take the total tax, that is output tax minus input tax. Total tax payable at the output level less the total taxes paid at the input level. This has been found to be more convenient. So this method is being followed. Earlier in our sales tax system we introduced VAT, value added taxes system. We followed the same way. And in central excise and service tax we are following SENVAT credit scheme. That SENVAT credit scheme is also enabling the value added taxation system. In India gradually we introduced value added taxation system. We switched from gross value method to value addition method. So this GST is nothing but the same value added taxation system with an improvement. It is an updated version, you can call it. It is an updated version of value added taxation system in India, because goods and services have been merged. The state and center barriers between state and state, barrier between center and state has been removed now. It's a wonderful idea. So why the ITC? Because to remove cascading effect, to make the goods and services reasonably priced, otherwise inflated. So to remove that cascade, when you remove that cascading effect, the prices are not unduly inflated. They are priced reasonably. Okay? But this is a multi-point tax. Every time there is a supply, there is a tax, but the tax is only on the value addition. That way government is also gaining, not losing much. Okay? So why we got the answer. And how the input tax credit scheme works, we have seen the example. See, I don't need to explain further. How it works? It works like this. There is something called input tax credit, and which is a tool. You can say input tax credit scheme is a tool of value added taxation system. With the help of this tool, cascading effect is removed, and it is possible. Value added taxation system is made possible because of this ITC system, ITC mechanism. So how it works? It works like this. I think I am able to reach out to you to the level of understanding, even because this is meant for general public. So even non-commerce literates should be able to understand. That is the objective of this video lecture. In fact, I have already told you it is not as simple as that. The technicalities are there, and I have not considered all these technicalities while explaining the concept of ITC. What is ITC and how it works? Why ITC and how it works, which I try to explain. So thank you very much. And if you like, because on ITC I am going to upload many more things. I have started from the simple concept, simple working mechanism, and gradually I will go into the technicalities also. Gradually when you go, you don't find it difficult at all. When you go gradually, you don't find it. Okay? So I am going to upload the varieties of things on input tax credit also. If you like this, please subscribe and you will be able to get the other videos also. Thank you very much. Thank you.